In this video, I'm going to show you why WeWork is set to possibly have a short squeeze over the coming days to weeks. And these short squeeze numbers are actually at all-time highs, so very intriguing, and I'll cover that in a second here. Also, at the end of the video, I will give a price prediction based on technical analysis. So with that being said, let's dive right in. So WeWork is the #2 trending stock on StockTwits right now, and it's been getting a lot of retail chatter as prices are up over 85% today. And there's really no real news that is causing this move higher. So WE is on track to end the session with the biggest increase the company has had since October of 2022. Still, the stock is down over 90% year to date and almost 98% in the stock's history, as the firm has substantial doubt about its ability to continue to operate. So last week, WeWork said it started the process of renegotiating nearly all of its leases in order to fix its inflexible and high-cost lease portfolio. So for those that don't know, basically WeWork pretty much just leases out office space. So when work from home hit, obviously this stock and this company was kind of caught flat-footed, right? They're caught kind of holding the holding the workspace bag, if you will. So obviously the company has been hurt by that. But with that being said, let's take a look at the short interest numbers for this stock. So yes, only 5% of the float is sold short, but it is worth noting that there are 0 shares available to be shorted at this current time, and we've been fluctuating from basically a couple thousand shares to 0 over the past day or so. And we can see that short borrow fee rates have jumped to 155%. For those that don't know, this basically means that investors who are lending out their shares are requiring a 155% annual return for doing so. That's what the short borrow fee rate is. So basically, as this rate rises, it becomes more expensive for short sellers to short the stock. And we're at 155% right now, and the average number for short borrow fee rate is about 0.3 to 3%, so we are well above the average rate, and this definitely signals that it's becoming tougher and tougher to short the stock. And one number that's at an all-time high is failure to deliver numbers for WeWork. For those that don't know, failure to deliver basically is just when a short seller doesn't deliver back the shares that it was supposed to. And all this means is the failure to deliver number of 2.9 million shares basically means that over the next 60 days, there needs to be 2.9 million shares bought by these short sellers, or the SEC will come after them. So they have basically a 60-day window to actually fulfill their promise and deliver the shares. But within this 60-day window, if they don't do so, the SEC will come after this company. Or excuse me, they will come after the short sellers who aren't actually delivering the shares. So with that being said, though, let's keep it moving. Obviously, short interest is pretty intriguing, and I do think we are at a high likelihood for a short squeeze over the coming weeks for WeWork. But with that being said, obviously the company has its issues. So just last quarter, we saw it was 19 million shares sold by insiders. So a ton of insider selling. And, this is kind of unfortunate because it just signals to the market that those insiders with the most information on the company are selling out of their shares. And they're doing so at extremely depressed valuations, right? So, or depressed stock price relative to its own history. So the stock IPO'd at $400, and now we're trading near $5. They're not selling because the stock price is up, right? They're selling because they probably have a negative view on the stock. Obviously, not a good sign for shareholders. But with that being said, it doesn't mean mean everything, right? It's not the end all be all, but it still is a significantly bearish signal to the market. And then with that being said, let's take a look at some of the changes in these institutional shareholders. So we saw SoftBank triple their holdings last quarter. So we figured this out through a 13F update. Basically, once a quarter, we get a 13F update, which tells us what the large asset managers are buying, what their current holdings are. So we saw that SoftBank increased their holdings 3x. And then we saw the Vanguard Group increase their holdings by 25%. So Vanguard is actually one of the largest asset managers in the entire world. So to have them increase their holdings by 25%, definitely a good signal. And we saw Capital World investors actually buy in for about 19 million shares, which definitely signals that there are at least some investors on Wall Street that are still bullish on the stock, and Capital World is actually one of the largest investors in the entire world. So that definitely signals, some bullishness. But it's also worth noting that BlackRock decreased their holdings by 27%. So that's obviously not good to see. We did see Charles Schwab increase their holdings by 238% though. So definitely some buyers, but obviously there are some sellers as well. And then with that being said, though, let's take a look at the company's financials. So we can see here that they obviously don't make any money, and their net long debt divided by assets is 17%, which is actually below their sector median, which is a solid sign for the company. And we do have price to sales of 0.02, which is well below the sector median. Obviously, though, the company is in a really tough spot on its balance sheet, I should say. So that obviously weighs into everything here. And then revenue growth over the past year was 13%. Unfortunately, we're projected to see a decline in revenue of 4% over the next 12 months. And then revenue growth for the past 5 years has been 29% historically. That's that compound annual growth rate. And then let's take a look at the profitability for the company. So we can see here that they have a gross profit margin of 82%, which is actually well above the sector median of 67%. But unfortunately, they have a negative 48% net income margin, which is obviously pretty poor relative to the sector median of 11%. And then with that being said, let's take a look at the company's balance sheet. So WeWork here on the left, we can see that the company has $205 million in cash and $17 billion in debt. So that means that the company has $16 billion more debt than cash. And given that the company has net operating cash flow in the negative 700 millions, that definitely tells you that we are in a pretty tough spot on the balance sheet, and we're going to need to see some things turn WeWork's way for the company to simply keep operating. Right now, with a negative $70 book value per share, it does look like, when you look at the financials of this company, like we're heading to bankruptcy. That's what these financials tell you. Obviously, that doesn't mean that we're heading to bankruptcy. Anything could happen from now and over the next couple months. But as it currently stands, the financials, the balance sheet especially, looks absolutely disgusting. It looks grotesque. And we could see some more downside for this company. We could see the stock go to zero, to be quite frank. But with that being said, let's throw away all the fundamentals. Let's throw away all the financials. Let's take a look at the chart and see what the technical analysis is telling us. So we came up to test this resistance level at about $7, and we actually rejected it intraday. So the high of the day was around this 670 level. So high of the day was $6.72, which is right at this $7 resistance level. We rejected, and we obviously moved lower for the day. This leads me to believe that we could see a continuation of this move lower. And this $7 level is where shares actually found support back in June. Twice in June, we found support at this level, moved higher, and now we're moving lower, and we just rejected that level. Past resistance becomes new support. Past support becomes new resistance. We're seeing that here. So unfortunately, it does look like we will see somewhat of a rejection for WeWork over the coming days. Unfortunately, anything could really happen with the stock like this. Personally, like what if we were to look at the short interest in a vacuum, it does look like a short squeeze is somewhat likely. So I want to give that piece of optimism to the bulls that are watching this video. But at the end of the day, the financials look horrible. The chart is implying more downside as well. So with all that being said, you kind of have to be a little wary and a little concerned about the stock. It is worth, though, saying this, that on average, the best month in the stock's history is September. So on average, shares do increase 10% in September. Obviously, we had that big increase today, which is probably pulling that number up a bit. But at the end of the day, the financials don't look good. The chart doesn't look good. Short interest is implying a big short squeeze, though. I do want to just acknowledge a reality that the short interest numbers for this stock are staggering, and we're seeing all-time highs for numbers like failure to deliver, which does signal that 2.9 million shares are going to have to be bought within the next 60 days if short sellers want to not be chased after by the SEC. So with all that being said, I hope you enjoyed the video. I will end it there. If you got some value from this video, please leave a like. We post company breakdowns and important market moving news on this channel on a daily basis, so make sure you are subscribed. If you would like to receive my daily portfolio moves, my exits, my entries, and see how me and my team of analysts are trading the markets, join the Discord through the link in the description below to get our free 7-day trial. Also, if you would like to join our free daily newsletter, sign up to our Substack, which is linked below as well. With that being said, good luck everyone. Happy trading, happy investing.